We've had earnings from some very important and key members of the NBFC sector overnight, and we are going to now take stock of that with Jignesh Shial. He's the Director of Research and Head of the BFSI Sector at InCred. Jignesh, good morning and thanks for taking the time out. Let's start with your stance on Bajaj Finance. Some interesting updates as well coming through. What are you making of the earnings firstly?
Obviously, thanks for the invite that I'd got. Sorry. Bajaj, yesterday's numbers have been pretty good. There had been some rise on the stress level, but obviously what management has been highlighting, there had been a rural stress which has been building up since a while, but now, it looks to be, as far as what management is talking about, that more or less for Bajaj at least, the stress has already been peaked out, and going forward, we will see that the trend has been improving. Obviously, they are cautiously optimistic for now, but Bajaj being one of the largest NBFCs, having a significant presence in rural India, they have a relatively fine understanding of the trend and all, and they have been highlighting that stress has been peaked out, and going forward we should see a decline. So that's definitely a good news, and that's what I guess the stock is basically reflecting.
Right. Jignesh, also there is a suggestion that they are looking to do away with the two-wheeler finance now. And it's actually a little bit of a surprise because, of course, naturally, a lot of that is towards Bajaj Auto. But if they do away with that, what does this mean for the sector? Because there's a significantly large player here moving out of that. What are you making of this?
No, I mean they are not saying that they are moving away from the two-wheeler space. Basically, what is happening is that Bajaj Finance has basically started as a captive financing NBFC for Bajaj Auto, but now Bajaj Auto is basically starting with their own NBFC, which is under the separate group altogether. They will be doing two-wheeler financing for their own vehicles and all, a two-wheeler, three-wheeler, and that's where Bajaj Finance as an entity is moving away from it. But obviously, I think from 22 onwards, they have started with their own two-wheeler financing business, which is for other than Bajaj Auto two-wheelers, which they're doing it up. So they will be consistently improving the penetration and all. They're just moving away from Bajaj Auto financing part, which is captive NBFC arm that they have started with it. So definitely that is the area where they are going to do away with it. But overall two-wheeler financing still remains intact for them.
But specific to Bajaj Finance, then Jignesh, will it not, impact operations because there should be some wind down of that are catering to two-wheelers, at least from Bajaj's finances point of view, right?
Yeah, definitely there will be some impact, which will, I think, the rundown will have an impact on the profitability and all over a period of time. But as even yesterday's call, the management has highlighted, obviously being moving away from captive has always been a difficult task because they've been funding it up pretty well. But on the growth front, definitely that rundown will have a bit of an impact, on the profitability side. But even on the credit quality side, that will be a good news for them because obviously in general, whenever it has happened that there is when you do a capital financing, funding and all, the credit quality gets a bit of a compromise on that particular part. So moving away from that particular piece and getting into a two-wheeler financing for other than Bajaj Auto, the impact will be positive on the credit quality front. But obviously, profitability and growth will impact at least for next couple of quarters till the time the entire rundown happens.
Right,
But on the
Jignesh.
asset quality side, that will be a good news. Yeah.
The other thing that came through in the conference call yesterday, and please correct me if I'm wrong, we understand that clients with more than 3 live unsecured loans are now showing a higher propensity for default. That said, even as against that, the point to counter that is the customers with exposure to more than 3 unsecured loans is now just 9% of the book, as against 13% earlier. So how are you looking at this change and this to and fro between this particular aspect?
Look, this is, I think, it's a bit of taken, adversely, but it's not that way. I mean, typically, when there is a flow, so Bajaj has highlighted clearly that there are set of customers which generally has two or three loans or more than three loans as well, where Bajaj has been exposed to it. Obviously, before pre-COVID also, there was roughly around 8% kind of a book, which extended till 13% when, obviously when the liquidity was pretty good. And there was definitely a good demand, and people were, were asking for it, and the environment was also good. It went up, it stretched up to 12, 13%. But when obviously when since last couple of quarters, management was very much cautious, so they realized that there is a overheating which has already been happening, specifically in rural India and all. So they started cutting that particular exposure. So from 13, it has again fallen down to around 9-10% currently, which is close to what they used to do it, earlier pre-COVID and all. But having two or three loans, that doesn't mean that that customer is always bad, or even there is no specific default which is happening. It's on a conscious side. They have taken a call whereby they don't want to get into that particular over leveraged customers more, and where the cut down has already happened from around 13% to around 9-10% right now. Until the time, being a seasoned player into unsecured financing for so long, obviously they know when to pull the plug out, or when again to start doing it up and all. So when they see that market has been improving, probably this particular share will improve. But for now, it has gone up from 8% to 13, and now again back to 9-10, which is a kind of a good news.
Point taken, Jignesh, and well pointed out as well, of course. But let's move on then to M&M Finance. And again, your initial take on the earnings.
Obviously, this quarter had been a relatively bad quarter for them. There had been a rise in defaults, and obviously that has resulted into provision increase. The net losses, as far as write-offs and all are concerned, still been captured or still been capped, but provision obviously has taken a toll, and that's the reason of profitability has been lesser. What management has been highlighting, it's a kind of delayed payments or repayments and not defaults as such. So there is a probability that the reversal will happen in the second half. But for now, definitely it's a kind of a concern that market is seeing it up, and that's the reason why the reflection is coming up. But what we see it up more is that, I guess, unlike other auto finance players, the diversity is still relatively lesser. Major of the book is still into auto financing segments at all altogether, and that basically is impacting M&M more, because when the auto cycle slows down or the auto demand slows down, compared to other NBFCs, M&M has a larger impact, and that is what is getting reflected here.
All right. But your view on collections, I know that the management has suggested that the first 15 days of the second half recoveries have been quite good. But there's also, or there's always this concern with respect to collections when it comes to agrarian states. Secondly, their auto segments, the CV segment specifically, it's not been encouraging. Can you talk to us specifically about some of these factors?
No, no, yeah, this you're saying is absolutely right. We need to keep an eye on it, because look, second half generally remains better than the first half. That has always been a tendency. That has been the historical track record also suggests. What we are seeing it up that the growth has been consolidating, and more importantly, the underwriting itself has been seeing a significant improvement in M&M overall. If you see it up compared to how historically they were done it up. But obviously, when the volatility happened and cyclicity is visible, we have to wait and watch out for whether the collection is going through or not. And if they are able to demonstrate that the numbers are pretty good for probably a quarter or two, then probably I guess we'll have a little bit more confidence on what they're saying in delivery. For now, we'll keep an eye on it, but I'll still stay on a positive bias that because it's more cyclicity and not specifically a default. I think there is a large probability, or there is a higher probability, that they will be able to recover it up in the second half, but we'll remain very watchful of it.
Okay. Jignesh, among the counters that still have to announce earnings, any which are on your radar and your expectations from some of them, can we expect same trends? I know a lot of these factors will depend from company to company, but largely, what are you expecting from the balance of the earnings season?
Look, I think obviously we have been seeing it up, and we've been highlighting also since a while that even management has been saying it up that credit costs or defaults are going to see a kind of a normalization like pre-COVID or not. So obviously there will be some hiccups which is visible specifically for those lenders who are more present into semi-urban and rural areas altogether. So defaults are definitely seen a kind of a spike, and that's what is visible. The expectation is that the second half will be better, so the commentary will be relatively good for the second half, but we have to watch out for. But what is more interesting is that the seasoned players, like whether it is Bajaj, whether it is from among the banking side, whether it's HDFC, even ICICI is supposed to come out with numbers over this weekend. I think the seasoned players who had built up this book since a while, since a quite long period of time, they are relatively better off at this point of time compared to those guys who has built up this entire book in the last 2 years or 3 years, where the major of the lending has happened and still seasoning has not happened. Those players are more vulnerable compared to those guys where the overall book is relatively more having more vintage and has seasoned out over a period of last couple of years. So we'll stick to the quality. That is the call. I think large names with a better underwriting and all, those are the guys who will be able to come out pretty quickly or pretty impressively compared to those guys where vintage is relatively lesser.
Right. Well, Jignesh, you lead that. Thank you so much for joining us and taking us through your view on not just those two heavyweights in the NBFC space, but the sector as a whole. Thank you so much for joining us here.